Welcome to the Tax Clinic. Today, we are looking at the exact reach of the UAE Electronic Invoicing System. In our last session, we established a baseline rule. The system does not automatically sweep up every single business transaction you conduct. That brings us to our first major exclusion. It is natural to look at transactions carried out by government entities and assume they are entirely outside the scope of electronic invoicing. The reality is different. Having a government entity on one side of a transaction does not grant an automatic pass. Basing your corporate tax compliance solely on the name of the entity you are dealing with creates a significant operational blind spot. The framework governing these specific exclusions is found in Article 4 of Ministerial Decision No. 243 of 2025. The text is clear. It provides no blanket exemption for government entities or the bulk of the activities they carry out. Instead of looking at the organization as a whole, the legislation isolates and examines the nature of each individual transaction. A transaction is only excluded from the electronic invoicing system if it successfully meets two strict conditions at the exact same time. The law requires a shift in how you assess your ledgers. You must ignore who is acting and look entirely at what the action actually is. The first condition requires the government entity to conduct the transaction strictly within its sovereign capacity. This applies to activities that are performed directly as part of an entity's official public authority and statutory responsibilities. These are functions unique to the state. No private enterprise holds the legal authority to execute them. When a municipality issues an official civic permit, it is exercising that exclusive public authority. If the activity is inextricably linked to a public duty, it clears the first hurdle toward an exemption. The second condition is equally strict. The activity in question must not compete with the private sector. The legislation enforces economic parity by keeping the commercial market separate from sovereign functions. Often, a government body will offer commercial services similar to those provided by private businesses. By entering this shared commercial space, the transaction loses its sovereign protection. While issuing a permit is an exclusive state function, that same government entity might also rent out commercial office space to local businesses. The moment the entity acts as a commercial landlord or a vendor, standard electronic invoicing rules apply to maintain fair competition. For corporate accounting and compliance teams, the practical application is straightforward. Do not classify an invoice or a transaction based solely on the name of the government partner. You must first meticulously assess the exact nature of the service being rendered. Then, determine the capacity in which the government actor is operating during that specific exchange. Finally, identify whether the private sector offers any competing alternative to that service. Compliance in the UAE system requires you to isolate the activity itself, completely unswayed by the identity of the actors involved. An exclusion is only valid where an official sovereign function meets a total lack of private market competition. Next time, we will examine the electronic invoicing rules from a different angle, looking at the specific exclusions that apply to certain airline services. Thank you for watching. At Tax Clinic, we simplify tax legislation and turn it into practical business decisions. Understanding the deeper logic of the law is the surest way to prevent costly operational errors.